Today I want to have a look at Realty Income Corporation, ticker O, which is currently down by 3% over the past month. Now, Realty Corporation is one of the more known REITs, as it is one of the few dividend stocks that pays out its dividends every single month, which makes it a great addition to any investor's portfolio. Now, as Realty Corporation has been getting beat down quite bad over the past 5 years, I want to have a look at my stock valuation spreadsheets and figure out whether it is a good idea to buy the company at its current trading price. And remember that if you do like these valuation spreadsheets, if you find them helpful, you can always download them at my Patreon in the link in the description. Now to start off, let's plug in the ticker for Realty Income, ticker O, and press enter, and all the metrics show up automatically right away. Now right here we can see the sweet dividend, a dividend yield of 6.04%, which gives us a dividend payout of $3.15 per share per year, and a trailing FFO, or funds from operations, payout ratio of just below 80%. Now, I generally don't like the FFO payout ratios to be this high, but we will have a closer look at O and figure out whether this is a sustainable FFO payout ratio. Now, we can also see that the analysts currently project the price of $61.32 per share by the end of the year, and that the institutional ownership is sitting rather high at almost 80%. With a beta of 0.93, which means that Realty Income's volatility is fairly similar to the one of S&P 500. Now, to figure out Realty Income's intrinsic value, we will have a look at the historical price to FFO model, the REIT multiples valuation model, and the REIT dividend discount model. Now, we will also have a look at the 9-pillar analysis and figure out whether O is doing well internally. Now, starting in the 9-pillar analysis, we can see that a few of the pillars are sitting in the red, and one of them is the price to FFO over the past 5 years, that we generally want to be sitting below 23, but is currently sitting at 26, which means that you will be paying a premium for the company's FFO. Now, two things I like to see the least when evaluating my companies is an increase in shares outstanding, and for the total liabilities over the 5-year FFO, negative dividends to be sitting above 3, and we can see that Realty Income has both of them sitting in the red. We can see that they have been increasing their shares outstanding by about 25% every single year. And what this means for you as an investor is that every single year you own a lower percentage of the company as they sell it out to other investors. Now, for the total liabilities, we generally want that to be sitting below 3, as it would mean that a company can pay off all their long-term liabilities within about 15 years. And when this number is sitting above 3, it signals to me that the company isn't bringing in enough FFO to pay off their long-term debts and to pay for the dividends they are paying out. Also, Reality's income consecutive dividend growth is sitting quite low, but we will see if it is a good dividend growth company later in the video. Now, their net income and their revenue and their FFO are all growing, so that is very nice. But let's scroll a little down and see the graphs. So we can see that the price to FFO is staying fairly similar, so that is nice. The profit margin is sitting very, very high, so that is great as well. Now we can see the revenue increasing, net income increasing, funds from operations increasing as well. Shares outstanding increasing, not great as I said before. We can see that the quarterly dividend isn't increasing by much, and that the total liabilities are increasing as well. Now, as I said before, if the total liabilities over the 5-year FFO negative dividends is sitting above 3, it doesn't make me too happy. And here I can see that the funds from operations are increasing, but that the total liabilities are increasing as well, which makes me a little nervous looking at this company. Now we can see that the earnings per share are staying fairly similar and that the FFO per share is rising slightly, meaning that the FFO does cover the huge increase in shares outstanding. But now let's try to figure out O's intrinsic value. So let's jump to our price to FFO model. And here we will take the historical price per share and the historical FFO per share and figure out the historical price to FFO over the past 5 years. Now, if the current price to FFO is sitting below the historical price to FFO, it means that the company is undervalued. So what we will do is take the average price to FFO historically and divide by the current price to FFO to get our decimal, which will then multiply by the current price and get our intrinsic value to be sitting just below $70, which is quite higher than the current trading price, hinting that O might be slightly undervalued compared to its historical price to FFO. But let's move to our next valuation model, which is the multiples valuation. And here we'll compare Realty Income to other companies which operate in the same sector, to other REITs, so REG, FRT, KIM, and SPG. We'll take these companies' stock prices and their FFOs and figure out their price to FFO, which we will average out, and using a similar method to our historical price to FFO model, we will divide it by the price to FFO of Realty Income and get our intrinsic value to be sitting at $48.25, which is about $4 lower than the current trading price. And this hints that Realty Income might be slightly overvalued actually to companies which operate in the same sector. In other words, REITs which invest into similar realities as Realty Income. Now moving to the final valuation model of the video, the dividend discount model. And here we'll value the company based on its dividend and its dividend growth potential. So we'll take the dividend payout over the past 5 years and figure out the average growth rate to be sitting at 1% every single year. So I will project a growth rate of 1% into the future, and I will plug in a yearly dividend frequency of 12 as the Realty Income pays out its dividends every single month. Normally we would plug in a yearly dividend frequency of 4, which as we can see would lower the intrinsic value. So when using these sheets, you guys have to be careful to always plug in the amount of the dividend payouts every single year. Now we will take the projected growth rate and calculate our next year's dividend, and we will then take the WACC and calculate the intrinsic value to be sitting at $48.76. Again, about $4 lower than the current trading price, very similar to the intrinsic value we got using our multiples valuation model. Now jumping to our ultimate valuation, we will average out the 3 models we just did, and we will get an intrinsic value of $55.55, which is 6.46% higher than the current trading price, or about $3.37. Now, if we plug in a margin of safety of 15%, we would get an acceptable buy price at $47.22. Now looking back at our 9-pillar analysis and seeing that Realty Income is selling out their shares at a rate of 25% every single year and that their total liabilities are sitting at a very high value, I would personally stay away for this company for a few more years. Now this certainly doesn't mean that you shouldn't buy the company. I'm just stating that I would rather put my money into a different company which I find more reliable and more in line with my overall portfolio. Now, if you guys did enjoy this valuation, make sure to leave a like and subscribe as it really helps me out. With that, thanks for watching and let me know down in the comments which company you'd like me to evaluate next.